Yeah, there we go. So, hi everybody. So happy that everybody is here with Garvin for our Investing in a Brighter Future webinar this afternoon. Garvin is, would you say, CEO, owner? What would you call yourself, Garvin?
Well, I'm a co-founder and I'm the chief investment officer.
Co-founder and
We,
chief
we decided
investment.
to have a sort of a level hierarchy here at Green Alpha. We don't actually have a CEO.
You see, yep. So, chief investment officer and co-founder, Garvin Jabusch.
That's what everybody says. It's actually Jabusch. You pronounce it like
Jabusch.
there's a Y in it, even though there's not.
Garvin Jabusch. So yeah, we are just going to kick it off. If you haven't already, feel free to type your name, pronouns, where you're calling in from. And with that, I will pass it on over to Garvin to share his screen and get it going.
Cool. Well, thanks, Matt. And hey, good to see everybody. I'm going to share a few slides with you guys. That might take me about half an hour, and then there's plenty of time for discussion. And I don't think she's here yet, but I'm here because one of 350's leadership, Micah Parkin, who is an amazing climate warrior. I've known her for about a decade, and she has never let up for a day that whole time. No compromise, full court press all the time, tireless climate warrior. You just have to admire her dedication. And when she asked if I'd be willing to talk to 350, I just said, anything for you, Micah, 100%. So here we are, and I'll go ahead and get started. I'm gonna share my presentation. Let's just hope that goes well. Don't see why it wouldn't unless Zoom is somehow affiliated with CrowdStrike. All right. So I'm going to start by sharing just a couple of points of thesis. This is super high level, but I wanted to dial focus down on what we're going to be talking about. First point of my thesis is just an economics truism. Economies are shaped by how and where they invest, or to put it in wonky economist speak, tomorrow's production function emerges from today's capital flow. It's just simply true. If you build a new coal plant, you're locking yourself into the coal economy for as long as that plant lives, right? It's as simple as that. Today, most investment is still directed towards the industries of the destructive economy. I'll show you some numbers around that in a minute. And the asset management industry, of course, since it basically controls the direction and flow of capital, is complicit in perpetuating the destructive economy. So because of the first bullet, the fourth bullet obtains only investments in the regenerative economy, not greenwashed funds, not international diplomacy like the COP process or unenforceable agreements like the Paris Accords, at least so far, will result in the actualization of the regenerative economy. What will? Investing in it. Kind of as simple as that. Therefore, it's time to change how asset management works. This is what my co-founder Jeremy and this is the reason we founded Green Alpha, to try to move the Overton window and make asset management work in a little bit more of a regenerative way. Okay, so that immediately begs the question, how can you actually go about building an authentically sustainable stock portfolio? Again, as compared to greenwash. We're going to have a look at a little bit of greenwashing in a sec. Well, it's right in our own marketing tagline, managing the risks that matter. You've got to manage the risks that matter. For those of you, I imagine most, who do not work in financial services, a couple of you here I know do, or have at least, the main measurement of risk in our industry is volatility, specifically share price volatility or fund volatility compared to a big benchmark index. Most of the time people think about the S&P 500, although there are others. If you're more volatile in terms of your share price movement every day than the S&P 500, you're considered risky. If you're less volatile, maybe you're considered a little bit less risky. As crazy as it may sound to us as more climate activist oriented people, my industry actually believes that volatility is a more significant risk than the climate crisis, crazy as that may sound. Not everybody believes that. The think tank at Davos, the World Economic Forum, which, yes, is a bunch of white middle-aged billionaires that throws a big party every year that's ostentatious and crazy. They also have a pretty sharp think tank, and every year they put out this report of, they survey like 4-digit of CEOs, and they try to gauge their economic, what they're worried about most in terms of degrading and undermining the economy over the next 2 and 10 years. Anybody planning to save for retirement or any kind of a long-term horizon, which is what Green Alpha focuses on, is very much worried about at least the 10-year horizon and maybe 10-year, maybe 20-year horizon. So what do these guys, mostly guys, unfortunately, but also women in charge of the biggest organizations in the world, think are the biggest risks to the economy? Keep in mind, they're talking about the risk to the economy when they answer this survey. Extreme weather events is the top one. Critical change to Earth systems, biodiversity loss, natural resource shortages. And then even some of the ones that are below it, while they might be coded societal or geopolitical, like involuntary migration, we all know those are climate issues, right? Including societal polarization. And then, of course, pollution. I would move that one up. But, you know, I'm not, they don't poll me every year. I'm not one of the world's 1,000 largest organizations, unfortunately. So these are the risks. This is the list of risks that Green Alpha attempts to invest to defuse. And we don't actually attempt to serve the master of low volatility. We go right at the companies and industries that we think are going to de-risk or defuse these biggest risks to the economy. And via that path, de-risk the entire economy and therefore our investments. But also, clean tech and regenerative businesses are among the fastest growing in the world. So it also, fortunately for us, turns out to be a bunch of fantastic opportunity sets as well. Okay, so how do you go about doing that? I know this is noisy as hell, and I'll just try to very briefly address it. This is those of who have been exposed to financial services are going to be familiar with the funnel, which is where a portfolio manager says, "Oh, we start with the index, and then we narrow it down a little bit and give you some kind of a subset of the index, and this is our secret sauce." We don't work like that. We start with a blank sheet and build a portfolio up from nothing, as opposed to trying to Frankenstein an index into something a little bit more sustainable. Newsflash, the big indexes are not in any way sustainable, and Frankensteining it is generally not going to work. So instead, we start with a blank sheet. Okay, if we think about a regenerative next economy, we call it the next economy. We borrow from the work of Daniel Kahneman and Annie Duke and the smart decision-making scientists to think about how to get there. And what they will say is, well, imagine you're at the end game you wanted to get to. So in this case, a regenerative economy. That might sound like a pipe dream, but it's our dream. And then you backcast. They call it backcasting. Look back over time and try to imagine the things that almost prevented you from hitting your goal. Well, for us, those are the big system level risks as identified, or at least partially, by the think tank at Davos, right? Pardon me, fighting a tiny bit of a cold. So what we do is we start by saying, okay, what are all the things that need fixing in the economy in order for the economy to be sustainable theoretically indefinitely? Well, it's everything we saw on the World Economic Forum chart. Then we ask ourselves, well, what are the fixes to those things? That's the second ring as we go through our not funnel chart. So in energy, that could be, renewable energy, because what we need to do is decarbonize and also get rid of tailpipe emissions and all kinds of toxics that come along with that, right? Then in our third level of analysis, we look at the sectors where those technologies are being applied. So in the case of energy, for example, that might be at utilities or at actual manufacturers of the equipment that provides zero greenhouse gas electricity. And then finally, in the last stage, we say, okay, within those sectors and industries, what companies are actually applying these technologies and out there in the world doing it? Not only that, which ones are doing it with the most intellectual property, so the deepest moat around their business, and are the most fundamentally sound in terms of investability, but most importantly, are also scaling very rapidly and gaining market share away from the busted, destructive, dirty way of doing things. So you might think of like solar electricity generation taking market share away from coal generation, which fortunately it is, albeit not fast enough. Okay, so that's how you go about doing that, and you want to arrive at this end state. This is a very high-level zoom-up picture of what we think a regenerative next economy can look like. One, it is being and will increasingly be characterized by ever-increasing, dramatically increasing economic productivity gains. In simple terms, what does that mean? Getting way more stuff out of way fewer inputs. This is the path to sustainability. It's the best way to get there. Secondly, these awesome new means of production in the first pillar have got to be powered by entirely renewable energies. I define that as an energy with zero cost of fuel. Why do I define it that way? Because it avoids slightly greenwashy crap like wood pellet burning or even nuclear. It has to truly be a regenerative form of energy that we get for free from the world or the sun, right? Third pillar is this economy has to be increasingly characterized by waste to value supply chain, sometimes called the circular economy. Think about electric vehicles. We need electrified transportation so that we'll be zero emissions, but the extraction process of lithium can be destructive. Well, when we have enough lithium in the economy, we can stop hammering on primary geological resource and just indefinitely recycle the lithium that we have. So we're going to have to get through this extractive period, but at least then it can stop. Unlike with the fossil fuels economy, wherein when you burn a tank of gas, you literally have to go back to the well for a new tank, and it can never become circular no matter what. At least even with lithium extraction, at least the electric transportation economy can become entirely circular at some point. And then because the degradation of social cohesion, as we can see very clearly right now, is itself a massive systemic risk. We think there has to be less inequality. People have to just feel better about the world, or we're not going to solve a lot of problems. That one's harder to invest for, but yet I felt it was important to make it one of the pillars. All right, here comes where we learn that asset management is not helping the cause. How close are we to the next economy? Not very. Fossil fuels still account for 82% of primary global energy. To hit net zero by 2050, here's what would have to happen. You can see on the right side of this chart. So you can see up through 2023, as far as this chart goes, what percentage of primary energy the fossils still represent, coal, oil, and nat gas, respectively. What they would have to do by 2050 is fall to very near zero. We're not doing that. We're actually still growing these three, as you guys will know better than anyone. Now, renewables are growing, but there's just so much energy demand that fossils are still growing in tandem, and meaning we're still locked into an awful lot of pollution, but also warming. A little bit of an interesting chart. I won't belabor it, but when if you guys would like, I can share the deck with Matt. He can distribute it. But this is how energy has changed over time. Most recently, you can see that coal has fallen off quite dramatically. This is encouraging, but even with its big drop off, it still is sitting right about there where wind and solar are cumulatively. Less encouraging is the massive rise in nat gas. It is true that non-hydro renewables have been growing exponentially the last couple of cycles, basically because they're getting cheap, not because they're saving the world, but because they're now cheaper than fossil production. Okay, so let's look at them as a percentage of our energy mix. You can see these pink bars sitting atop the gray bars are the parts of primary energy use that are provided by renewables. And you can see over the past few years, renewables have been slowly gaining market share from 4.18 in 20 to 469 in 21 to 543 in 22. We're still waiting for the final 23 numbers, shockingly, because it's July, but we are. This is how slow government agencies are. Okay, but also note that the gray part of the bar, except for the pandemic in 20, has grown every year. This is because total energy demand has grown every year, and just as much fossils are feeding that demand as renewables are, almost. So they continue to grow, even though we are growing renewables at a very rapid rate. So the overall picture for the climate is not that great. Why do fossils continue to grow that rapidly? Because we continue to invest in them. Simple as that. Let's just look at the US. Here's petroleum production. 2023 was an all-time record year, 18.44 million barrels per day. This is under Biden, by the way, in case you were thinking that Trump was worse for the climate than the Democrats. It's not actually true in practice. Dry natural gas production. This is measured in billions of cubic feet. In the 23 cycle, we had 102. I've been told that in 24, it's expected to hit 109. So fracking is booming, y'all, booming. Global coal demand. We saw in the United States, it's declined quite a bit, but globally, it's going to hit a record high in 20. It did hit a record high in 2023. 8,536 million tons, all-time record for coal. So, as reported here by Wired, emissions should be plummeting. Instead, they're breaking dangerous new records. We've seen why in the previous few charts. Here's emissions, according to the Financial Times. You can tell because it's that cool salmon pink color that I snipped it right out of the Times. No, I didn't have permission. And as a result, of course, the global average temperature is rocking. I mean, what do you expect to happen when emissions climb, right? And you guys are familiar with that. You're 350. I don't have to belabor it too much. We now have a rolling 13 months of the global average being in excess of 1.5 degrees Fahrenheit above pre-industrial times. So it's safe to say that the Paris Agreement threshold is in the rear view. IPCC refuses to say that because they insist that it be a 30-year average before they go ahead and make the declaration. But I think 13 months is a lot, even if we do dip below it at some point. Clearly, we've exceeded it for a pretty long time period now. You can see that June to May of 2024 was an average of 1.63 C above pre-industrial, according to the European Union on this chart. So scary stuff. Here's, you guys all know this map from NASA. It's not just the EU saying that, also NASA concurs. And the only parts that are below average are right here around Antarctica. And that's just because Antarctica is melting and temporarily cooling the water around it. So those little blue spots aren't actually good news. And last year, we learned in Nature Sustainability from some of the world's most preeminent researchers that collapses can actually occur a lot sooner than a linear projection would predict. I highlighted the relevant section for you guys. Collapses occur sooner under increasing levels of primary stress, but additional stresses of noise in all models. They use 4 models at Monte Carlo simulation if you're a nerd. Bring the collapses substantially closer to the present day by between 38 and 81%. So we're closer to the edge than we think. And if you want to know what increasing stressors look like, that's what it looks like. So we're living in a world of increasing stressors, which we now know is more dangerous than we ever even thought. Okay, here comes the money part. This is what I try to do. Here is through the 22 cycle, which again is most current, but we'll get updated. It doesn't look a lot better, I can assure you. We hit a direct investment in renewables looking at about 1.265 trillion. This is good. It was an all-time high, and for the first time in terms of direct investment, it hit parity with fossil fuels. So fossils also, in terms of direct investment from funds, from hedge funds, from asset managers, from sovereign wealth funds, what have you, hit about almost 1.3 trillion. This is the same as it was for fossils. Unfortunately, this is not the only way fossils get invested in. Okay, is that good? It's not that good. That green wedge here is the green wedge on the left of this chart. This is IPCC's gap assessment. It's how much is being invested in green and how much needs to be invested to hit net zero by 2030 in the bands around this orange line. So we're at about 1/5 of what we need to be investing in renewables in order to slow the climate crisis. So this number looks good, and it is good, but it's only 1/5 of the way there. Okay, scary. So much so that the IPCC, which, you know, has to be unanimously, the wording has to be unanimously agreed upon. I don't need to tell 350 that, by all 190 member nations. They actually came right out and said any further delay in getting this funding up to speed is going to miss a brief and closing window to secure a livable future. That's just great. So how are fossil fuels getting all this investment if it's only 1.3 trillion direct investment? Well, it's subsidies. This is what Micah works on constantly. Mike, if you've joined, thank you. Keep up the fight. You can see here that through the 22 cycle, they got a little bit over 7 billion in direct and indirect subsidies. This is from G0 via the IMF. So it's a pretty reliable number. So if you take this 7 trillion and you slap the 1.3 trillion directly invested into fossil fuels, you've got about an $8 trillion number. Just for context, you guys, global GDP is about $100 trillion a year, meaning currently we are pouring about 8% of global GDP onto the fossil fuels industry. Remember the first bullet in my thesis. The production function of tomorrow emerges from the investments of today. If we're pouring 8% of global GDP onto fossil fuels, we will be living in the fossil fuels economy for a long time. And all those emissions growth numbers I shared will continue to go up for quite some time. It's very, very dangerous, the world we're living in. So much so that even allegedly progressive news organizations such as the New York Times report the fossil fuels aren't going anywhere. They're probably right. So you guys might have heard of ESG investing, maybe not. It stands for environmental, social, and governance. It's supposed to be taking environmental considerations into account when making investment decisions. It was all the rage a couple of years ago. Politically right-leaning entities such as the Heartland Institute hated it, and they've weaponized the term ESG. I never liked it anyway. I don't really care because it never really worked. Let me show you why. The most respected and largest and most widely subscribed to MSCI ratings entity in the world is MSCI. And they give shockingly good ratings to shockingly destructive companies. You can see here, this is snipped right off their page, again, without permission. ExxonMobil is considered a triple B ESG company, meaning it's perfectly good for an ESG branded fund to invest in. JP Morgan, the world's largest investor into new mountaintop coal removal, among many other horrible investments, is considered an A. Chevron is considered an A. These are fantastic buys for a green fund, according to MSCI. This is what I mean when I say asset management is complicit in perpetuating the climate crisis. Not only are they continuing to pour money onto the fossil fuels industry, they are encouraging everyone, even responsible investors, to keep doing the same and telling them these companies are perfectly great. The largest ESG-focused ETF is the $20 billion iShares. That's a BlackRock joint. Is their ESG Aware fund. Its ticker is ESGU. It's got over 5% of its assets in oil and gas sector. Exxon alone is 1.2% of the ETF. It's the biggest ESG fund in the nation. You know, the chief investment officer of Deutsche Bank says big oil is just fine to put in ESG funds. Big spending cements liquefied natural gas and energy mix for decades to come. That's what we've been talking about. I won't pause there. Look at something curious, you all. The world's biggest manufacturer of solar panels, Jinko Solar, not tiny by any means. $100 billion market cap company. It makes over 100 gigawatts in electric generation capacity every year. You'd think if Chevron gets an A, that Jinko would get some kind of a triple A or something. MSCI declines to rate it at all. Sunrun, America's largest residential installer, MSCI declines to rate it at all. And this is curious here. Moderna, triple B. This is lower than Chevron. Now, let me just draw your attention to something. The S in ESG is supposed to stand for social. Moderna, for whatever faults it may have in terms of maybe not making enough vaccines accessible cheaply enough, is basically in the business of saving lives. And there are estimates that it saved, between 10 and 40 million lives during the pandemic. That is their business. How they're executing it might be up for a little bit of debate, but overall, we have to admit they're inarguably good for us overall. So this is an undeniable social good. Meanwhile, tailpipe emissions, general fossil fuels emissions are killing at least 10 million people prematurely annually, and yet Chevron gets an A. Well, I just have to ask the ESG industry in general and the investment management industry in general, if saving lives over taking lives isn't the ultimate social parameter you should be measuring, then, sorry to be blunt, what the fuck is ESG even for? Now, I hold all three of these companies in my ETF, and I got to tell you something crazy. If I were to sell these three and buy these three, meaning Exxon, Chevron, and JPM, my funds, my ETFs, average aggregate ESG score would go up. The world would think I was a greener fund if I sold these and bought these. So our industry is broken, and this is again what I mean when I say my industry is 100% complicit in perpetuating the climate crisis, and it's a problem. So even if you do have a fund that wants to operate in good faith, only 16% of companies say they have auditable ESG data they could even release. So even if you tried to have a solid ESG fund, it would be very hard. Okay, let's get to a little bit of greenwashing. BlackRock, the one corner of ESG that's still growing is decarbonization, because people do understand that the climate crisis is a problem. So they want to buy funds that they think are helping decarbonize, right? So BlackRock launched this thing that it calls, it's a carbon transition fund, and it immediately grew to 25%, became one of the largest carbon transition funds in the world. And yet, look, this is right from its own page of its holdings. This is the carbon transition fund's energy sector holdings. You can see there that it's Antero, it's Baker Hughes, it's Chevron, it's ConocoPhillips, it's Diamondback, it's Exxon, it's Kinder Morgan, it's Marathon Petroleum, Phillips, on it goes, right? They're straight greenwashing the world. Oh no, this is our decarbonization fund. Not. Psych. Thanks, suckers. Sorry, but that's the deal. Okay, let me just quickly dispense with IPCC and the COP process. I'm sure you guys are as frustrated with that as I am as climate activists. Secretary General has come right out and said, in face of this, this is recent, January anyway. Well, unfortunately, we seem powerless to act together. We've gotten nothing done. Well, that's true. Look at this graph of how much emissions have gone up versus the time plots of the various accords. Copenhagen, more emissions. Paris, more emissions. Glasgow, more emissions. When they update this with Dubai, it's just gonna look like this, right? So these agreements we do at the COPs are unenforceable and nobody does them. Why? They don't address where we're investing. They're like, sure, yeah. We're going to agree to keep warming to 1.5, but we're going to pour $8 trillion onto fossil fuels. These are incompatible decisions. Here we can see that the top 10 companies that have emitted since Paris have all increased their emissions since the date of the Paris Accords. In other words, the signatures on the Paris Accords were meaningless. I know that's a little bit of a harsh thing to think through, but it's visibly true by the numbers. So what the hell is the fix? Well, I think you guys know what I think. If we're gonna arrive at this economy, we simply need to, oh good, we're already at the discussion. We simply need to invest in it. Now, we can talk about different ways of doing that. Obviously, this is what my ETF exists to do. I don't try to be ESG. I try to cut the Gordian knot of ESG by only investing in companies that are contributing to one of these four pillars, and ideally more than one of them. But I'm not actually here to pitch my ETF. I don't really care if you buy it or not, but I would encourage you to look very carefully at everything you invest in, like any ETF, any mutual fund you own. Look at the holdings, even if it's an ESG fund, even if it's a decarbonization fund. Don't just take their word for it. Look at the holdings and make sure you agree that everything in there is helping to push the world toward a regenerative, decarbonized future. Unfortunately, you can't count on that. And same if you just decide to invest in bonds or individual stocks or even money markets. You should have a look at what you're actually doing. If you buy an individual stock, make sure you think that company is helping to light the way to a more regenerative future. As we learned from the ESG example, you can't take the ESG ratings word for it. So there's no shortcut. You have to do your own thinking. You have to look at the holdings and think it through for yourself. You can't use the shorthand of an ESG rating or anything else for that matter, because it's not actually in alignment with our goals of decarbonizing the world right now. So that is what I wanted to share with you guys. And I was glad I could bring a little bit more fire than usual, because you guys are climate activists. Believe me, when I talk to a group of financial advisors, I give generally the same message, but I soft pedal the hell out of it, because they are all very wedded to the idea that volatility is the biggest risk in the world and not the climate crisis. And so I have to be gentle with how I treat them. So it's super refreshing to talk to you guys and kind of lay it down the way I see it. Anyway, I'll stop sharing now. And I'd be more than happy. I did it in half an hour, Matt. Proud of me. And I'm more than happy to have a chat.
Yeah, anybody that would like to, feel free to use either the raise hand function or yeah, just put a little plus sign in the chat and I'm happy to call on you. But yeah, just want to first and foremost say thank you so much, Garvin. I want the people that joined after the fact just to know that this whole meeting is being recorded. So that way you can go back, you can look through everything that was said. There's a lot of information there, and if you're like me, it probably will take one or two times going through it to really fully let it sink in, right? So yeah, thank you so much, Garvin. And yeah, if anybody has anything else to say, feel free to jump in.
I understand that was kind of a fire hose, you guys. So I apologize if it was a ton of info, but
Oh yeah.
Garvin, I have a question. This is Shayna.
Hi, Shay.
Hi, and I'll try and go on camera. I don't know if my camera's working, but maybe it is.
We see you.
Okay, I'm on my patio right now enjoying the lovely weather in Seattle. But on the ESG point, so I work in private equity, and to your point, ESG was just all the rage a couple of years ago. Funds were getting, appointing ESG officers, the ESG funds. So I heard you that ESG wasn't truly measured appropriately, but like, what are your thoughts on was it just a fad where everyone's like, oh, we have to do that, and now it just sort of fell by the wayside? Like, if we can get the measurements fixed, like, can you see that coming back? Because it just seemed like it was all the talk for like 2 years, and then it just sort of fell down.
Yeah. I think what was going on there, I think why the big asset managers were were engaging with it. And I would describe that engagement, Shayna, as primarily lip service, as you can see by the holdings in the ESG funds.
Yeah.
But okay, so as far as it went, they were engaging with it. And I think it was for one reason, there was demand. Their clients wanted it. And of course, when they smell demand, they want to set up a product so they can have more assets under management, right? In our industry, we get paid by how much assets we have under management, right? So that's kind of the trick. And
Yep.
so that's what they were doing. And yet they didn't want, they still thought of volatility as the be all and end all of risk measurement.
Back to that.
Right? It comes back to that. And so they didn't want to turn up their volatility at all, which if you exclude whole sectors, such as fossil fuels, you're going to have a narrower set of holdings and therefore probably be a little bit more volatile. So when it came to doing true ESG, I guess what I'm saying is you cannot serve two masters, and they chose to serve the master of correlating with their benchmark rather than the master of having a sustainable product.
Yeah.
And that's what happened there. So, and that's probably the most generous interpretation. I think probably in some cases, they just thought they would make suckers out of people and sell them the same old index fund, but just put a green wrapper on it and charge 3 times as much. This is what BlackRock does. ESGU, if you plot it with the SPX, with the S&P 500, it barely has 5 basis points of difference over time on any given year. So they plot on a bar chart. It's hard to tell them apart, and yet they charge 4 times more for it. Because they're decarbonizing. So so I would accuse them of being pretty disingenuous, and others of just kind of serving the wrong master because we've all been told to be terrified of being volatile or nobody will invest with us, right? So I think that's what was going on. I think, and then what's funny, Shayna, is the political right took it seriously and they thought these ESG funds actually were decarbonizing when in fact they were just bullshitting, right? So the knives came out and they weaponized ESG, and now they've made all the banks afraid to talk about it.
Yeah.
I don't care because we never labeled ourselves as ESG because we're not. We're impact, we're sustainability. And so it was interesting to me that the right actually took it seriously and came out swinging against it and managed to step on it. In terms of actually having an impact on the climate crisis, it doesn't matter because ESG wasn't doing it anyway.
Right. Yeah.
So I think the direct answer to your question is something will emerge, but it won't be ESG.
Yeah.
It's going to have to be something a little, I mean, I hate to say it should be next economics just because that's my thesis and my baby, but it's going to have to be something similar to that because that's kind of, objectively speaking, the only way to get to a sustainable economy. Like you invest in it or you don't, and papering over destructive companies with nice grades isn't going to work.
Right.
And so I don't know. I think the best way to cut that Gordian knot is to not even try to mess with ESG and just go straight to, is this company or is it not? I guess the final thing I'll say on that is, I talk to MSCI analysts and they're a little bit annoyed with my point of view, as you might imagine. And they will say, damn it, dude, those grades are fact checked within an inch of their life. We're MSCI. And I can't disagree with that. I'm sure they are fact checked to within an inch of their life because you are MSCI, one of those thorough organizations. I mean, I used to work at Morgan Stanley, right? I know. And, but what I will say in response to that is, sure, you fact check all the details in there that you use to justify your position, but what you failed to do is frame check. You didn't actually set the framing right. Is this company helping or destroying the world? You never asked that question. And so all your henpecky little details that you build up into an A grade don't mean a goddamn thing because you didn't start with the frame check.
Right.
Right?
Yeah.
And then the discussion ends and they storm away, right? But yeah, I mean, that was kind of a long answer to your question, but you got right to the heart of the matter. Very, very incisive question, Shayna. Thanks.
Yep. Thank you.
I guess quickly, I had a bit of a question as well. I'm blanking on that acronym again. I think you just said it. The entity that's rating all of these different companies, right?
MSCI.
So,
Morgan Stanley
MSCI.
commercial something, yeah.
Yeah. So when they're rating all these companies, and for example, like you said, like Exxon getting a triple B, for example, right? Like, is the fact that these other companies, like you mentioned, like these solar distributors, like them not being listed there, is there any other regulatory body or anything like that calls that out? Or is that just, they are the top and they just kind of do what they want?
Yeah, no, SEC nor FINRA, these are regulatory entities in our industry, has never called them out for that. In Europe, the regulatory entities did, and they set up their own structure. And it's versus this, I mean, it's Europe, right? So it's really tedious, but at least they're trying. Uh, they set up this big regulatory framework, and funds are categorized by the article of the framework under which they fall. And there are articles 1 through 9. So they recognize quite a bit of gradation within funds and ETFs. So that's cool. Because there is a lot of gradation. It is a spectrum, of course. It isn't just green or not. And to be the highest ranking, the most sustainable, the greenest of the green, you're Article 9. You won't be surprised to learn that last year in 23, BlackRock submitted 21 products through the article evaluation process that they thought were ESG products. 0 of them received an Article 9. This incensed BlackRock, and they went on a PR campaign to say that the article system is fraudulent. By contrast, we're about to launch an Article 9 product here at Green Alpha in Europe. It's actually launching next month. So we're going to have some opportunity for some European clients to buy a nice Article 9 product. I was told by the advisor of the fund, it's a group called All Funds, and we're sub-advising for them for whatever technical merit that has, that we're the only US-based manager they could find that could offer an Article 9 product. We're just terrible at it here. We really think that oil's okay.
Thanks for answering that. Yeah.
Yeah.
Yeah. Hi, Garvin. This is an interesting presentation. Thank you for coming.
Hey, Paul.
I'd like to say, first of all, I'm a self-directed investor.
Cool.
I'm
Me too.
72 years old, been retired for 11 years and doing well.
Great.
But I'd like to see if you could talk about a couple different dimensions on this. And one is sort of the supply side, demand side, that the companies that you're investing in are only going to do well if they have customers. And ultimately, we are the customers. And our dollars, I think, especially, maybe I'm making assumptions too broad, but this group you're talking to here, we're probably more consumers than we are investors.
Yeah, most of us are.
So there's the actions as consumers are probably just as important for us as our actions as investors. And the other dimension of this is that, small investors, people investing in their 401k or their IRA, as opposed to institutional investors, I've got to be looking at this wildly differently. And so I don't know what your target market is, but it sounds like you're more retail. But the big bucks are probably elsewhere. I don't know if that's true or not. You could maybe expound on that.
Well, I'll start with a little bit of market segmentation of our clients. About a third are institutional, about a third are retail, and about a third I fall somewhere in between. Sometimes they call them institution light. So it might be like a family office, or something that's you could think of as a smaller institution, but certainly more sophisticated than retail. So we're about a third in each, and they value us for different reasons. I would say that most of that middle tier, the family offices and smaller foundations, there might be like a community foundation. It's not like the Rockefeller Foundation, but it's a foundation, right? I would say that middle tier is most likely to be with us because they're ideologically aligned. And the institutional tier is more likely to be with us because we have good long-term track records and they chase performance. Also, because we don't correlate, the truly sophisticated institutions love that because they understand they need to have allocations to and amongst and between a bunch of things that do not correlate with one another. this is what modern portfolio theory stipulates why diversification is important. If one thing's down, the other thing's up. Diversification is critically important. Well, as long as everybody's just piled into the S&P 500, they're not very well diversified. Yes, that's 500 companies, but it's where most of the flows are going right now, and therefore they kind of trade together. And so you're not extremely well diversified. And then with everyone trying to mimic the S&P 500 with their whatever slight different flavor they have, it concentrates the world even more into the stocks in that index, and it's a little bit dangerous. It results in them being a little bit overvalued. But even Markowitz, the inventor of modern portfolio theory, he wrote the book about it. He's still around. He's getting to be a pretty old guy, but he recently wrote a paper where he said, "You guys, when I said you have to diversify, I didn't mean to diversify amongst a bunch of entirely correlated assets. That's not what I meant." And a lot of people do understand that. The more sophisticated, the more they understand that. And so the institutions that we have with us are the ones that value that we're uncorrelated with the benchmark. And we're not negatively correlated because equities in general share a certain amount of correlation. But our correlation versus SPX versus S&P 500 sits right about at 0. So you can not call us negatively correlated the way that gold might be, but we're uncorrelated. And so the big institutions value that. And they're not with us for any kind, don't kid yourself, any kind of ideological reason. They like that we have good track record and that we're uncorrelated. And then the retail is sort of a mix of everything. They might have just been told by a friend that they like our ETF or something. Or they might be ideologically aligned, or they might just be chasing some performance. So I don't really get to interact much with retail investors. I don't even know who most of them are because they just buy shares of the ETF at Schwab or at E-Trade or at Robinhood or something. And so I never even know who they are. So I can't really speak to their motives, but of the clients I speak directly to, which as you can imagine are the institutions, to get an allocation from an institution, you go to their boardroom and give a pitch. So I know them and I know why they want me, right? And the ones that decline, I know why, I go give the pitch and they pass. I know why they pass. It's because they wish we were more correlated. So I judge them a little bit in my mind. I also think like, yeah, okay, so if you just want everything to be correlated, when that one thing you're correlated to has a bad year, that's not going to be that great for you. But okay, that's your business, So I don't know. Did you ask something else? Did I fail to answer what you even asked? I'm not even sure what I did right now.
Oh, well, I started out talking about the financial influence of consumers as opposed to investors, and how
that's a big deal.
If that's something you think about.
It is, of course. And it depends on the industry, of course. Like when it comes to power generation, no, that's going to be determined by utilities and regulators. And they're generally going to go for the cheapest thing they can get, which is fortunate for us because solar is the cheapest source of generation by far right now. Even when you bolt batteries onto it, it's the cheapest now. And it's only getting cheaper. So that's extremely fortunate to us. If you're a big utility, how it works is like this. Your public utility commission, state or local level or both, legislates how much you can charge for juice, right? So, say at peak, that's 25 pennies a kilowatt hour. And it's time for you to build out more capacity. Well, you can build a coal plant, which will cost you about 5 cents a kilowatt hour to make electricity with, or you can build a big solar plant, which will cost you about 1.50 pennies per kilowatt hour. Whatever the difference between your generation cost and what the PUC will let you charge is how much you make. Well, what do you think they're going to do? This is why solar is the fastest growing source of electricity in the world right now. And it has been for the last couple of years since it's become so cheap. And again, as Wright's law and production scales up, it's only going to continue to get cheaper. So the future looks bright on that level. So some things are system level, right? They're systemically set, such as electricity. Other things are all about the consumer, right? Cars. In that case, we are concerned about that. And we have to look very closely at so we will only invest in zero emissions transportation, period. No compromise there. I don't even like hybrids. So you have to be a pure BEV company for me to want you. And you have to build a better mousetrap. It has to be cost competitive. It has to perform well. It has to just be something there's demand for, because you're right. Consumers don't demand it. It doesn't mean a thing. It could be the best car in the world. Nobody wants it. Who cares? Right. And I would say the same generally of sustainability strategies. They have to be growing and therefore able to make money. But that's sort of almost an emergent property of growth, right? They have to be growing because if they don't scale, and as we saw on the gap slide, on the financing gap slide, if they're not scaling and they can't scale to be very big, they're not going to change a damn thing. If our solutions aren't big, we don't have a solution. So it's very important to me that we invest in the things that matter most, that people want the most, that are the best value mix for them, except for in the case where it's systemically set, such as power generation, but okay. So how do you do that? Well, you look for the companies with the most intellectual property around how to do something. So like in the case of Moderna, they own half the world's IP for how to edit messenger RNA such that you can affect a phenotypic change in the organism such that it can fight off a disease. Well, we owned them before the pandemic, so we actually made a killing on that stock because it was just very clear to me that that intellectual property was invaluable. I thought the worst we're going to do on that stock is when Merck eventually realizes what's going on there and buys them just to own that intellectual property. And the worst we'll do is maybe get a small premium. History didn't turn out like that. We earned a massive premium, but this is what I mean. You have to have a very deep moat around your intellectual property, and you have to be one of the top 2 or 3 in the world at what you do. So global leaders who can prove it with their IP, who prove it with their R&D investments, and who are making a positive change in the world. These are the companies I look for. So good question.
Yeah. So Ruth has her hand up.
Pass that baton.
Hi, I'm Ruth, and I'm just curious, when you said, how do you were talking about electric vehicles, and I'm curious, I'm curious, do you look at, has the company pledged not to do deep bed mining for lithium, for the balls? I don't know if you're familiar with that. And as Tesla has. And then what do you do with a company like Tesla that has really advanced electric car technology, but has, but socially, that's a hard pill to swallow, I guess, is what I'd like to say. So
Yeah.
how do you balance when those two, usually they seem to align in our, I guess, in my rosy colored glasses world, but in that particular case, I don't know that it does. And so how do you manage that?
Yeah, well, that's a great question. And obviously, every company is complicated. We don't live in a regenerative economy. We don't live in a sustainable world. Not everything is powered by renewables. Not everything is a waste of value supply chain. Far, far, far from it, unfortunately, right? So there's no such thing as perfect. Okay, so knowing that, Tesla's one good example, although any company in the world would be an example. But Tesla's an easy one to talk about because it's so in the news and people are so aware of it. So what I try to do is zoom up, learn, know everything I can about the company and how it does business. So yes, like, have they pledged not to do seabed? That is one good example of that. Obviously, that's crazy. It's also more expensive than doing evaporative, so I don't even know why that's a thing. The deep seabed is phenomenally expensive to mine, so I don't even know what's going on there. And if I'm being cynical, that's probably why Tesla agreed not to do it. They don't want to anyway. And so on balance, are the activities of a company doing more to lead us to a regenerative future or more to burn the place down? On balance, again, being acutely, even painfully aware that there's no such thing as perfect. Wow. Well, in the case of Tesla, I don't think we'd have electric vehicles in the economy at all yet if they hadn't pushed that. And now the narrative is, yeah, well, they're losing market share because everybody copied them and now there's a lot more. Okay, true, great. But that's a good thing. Like, nobody else would have even chased them if they hadn't been so successful, right? So we'd all still be driving gas burners if it wasn't for Tesla. And eventually, I think the EV transition would have happened because they're just so much more efficient and lower cost to own over time. And they can be ultimately a waste of value circular supply chain, even though we're not in a place where we can get to that yet. I heard one economist say, he thinks, this is a small aside, that he thinks that if we had about 2,000 kilos of lithium in the economy per person, we wouldn't need to mine anymore ever, because lithium can be indefinitely recycled, again, unlike oil or gas. So on that level, and then of course their storage business is huge. They deployed 9 gigawatts of megapacks last quarter. It made Wall Street notice that part of their business for the first time. It was growing 5 times faster than the car business, which is cool. Um, and uh, and then I would also say their work on autonomy shouldn't be fully dismissed. I'm not sure how soon they're going to get anywhere, but they're trying. Autonomy, of course, is all about the first pillar of the next economy, ever increasing productivity, right? So that's a big deal to me too. And yeah, their governance is a mess. The CEO has fully red pilled, and is pledging 45 million to Trump per month right now through the election. So I guess it'll be about 150 million to Trump super PAC. He's fully red pilled. He's gone off the rails on that front. Partially that's just payback to Biden, who hates him, and like he had a electric car day at the White House and didn't invite Tesla or Musk, but did invite Mary Barra and GM, which is a joke. They only sold 20,000 EVs last year. Tesla sold 2 million. So think about GE versus Tesla. GE has better governance. Okay, it might be a better place to work because it's a union shop. But let's zoom out. 2% of the cars GM sells are BEVs. The other 98% are still poisoning our cities and warming the planet. And they don't care. They recently scrapped a bunch of plans to make new EVs under the guise that there's no demand. There's demand. They just don't want to do it because they have a hard time making money on it. So for Biden to invite Mary Barra to the White House and say, wow, she's transitioned the economy, she's the global leader on EVs, well, it's straight bullshit. And of course it incensed Elon. He's being a petulant baby to back Trump as a result of that, but Biden was an idiot to do that. So I don't know. The whole damn thing is super complicated, but I've got to zoom up and be like, wow, Tesla, for all the faults of the CEO, has done more to advance the regenerative economy than any other car maker in the world. Full stop. Right? Now, do I think it? So we've been in it since right after the IPO. So we've crushed with it, 100x return. More than. We've got about 170x return on those shares right now, even with the recent pullback-ish. So now, do I think it's going to continue to be a good investment going forward? That's a different question, and it's about the merits and the fundamentals of the company as opposed to its climate impact. And I have to keep both of those very clearly in mind. I'm not sure we're going to hold Tesla indefinitely, although my clients are terrified of me selling it because it's going to represent a massive tax burden. We literally have shares at lots at $1 per share, and it's currently 160 something. So that's going to be a big tax hit when we finally do sell it. But I'm not ruling that out. But it's not because of governance reasons. It's because I think it might have run its course.
Well, thanks. That because these is, I mean, that just helps clear up my mind because these issues are complicated, and I'm not a finance person, but I'm also retired, so I need to. Yeah, I'm trying to figure out how to balance all of this.
Yeah,
and it's hard.
It is hard, and do not get me wrong. I think the fact that the CEO has become a wingnut transphobe and has a trans daughter who's disowned him is not okay. And yet, as an asset manager, my fiduciary responsibility is to my clients into earning returns. So I have to dispassionately evaluate the company as opposed to get pissed off that he's a transphobe and dump the shares. I don't have that luxury. I've got a lot of clients who I am responsible for safeguarding their wealth, right? So I have to make my very best objective, dispassionate judgment about, one, whether this is a company of the future because it's helping fix the planet and therefore de-risk the economy. That's important. And two, whether they're going to be able to continue to do so. Now, part one is inarguable to me. Part two, I'm still assimilating data about, and it's a challenge. And one could, if I were to make the argument about the personality of the CEO, it would be that it's getting to be toxic enough that it might be destructive to the valuation of the company. When I'm comfortable making that determination, it's time to sell. But it's not going to be because in a fit of pique because I'm pissed off at that guy. I can't afford to be like that.
Thank you.
Sure. I know that was a tough one. I'm not sure that was a very satisfying answer, but it's
no,
it's
it was very illuminating. I mean, that's not a yes or no question. So I really appreciate your explanation. Thank you.
Yeah. And we could go there with Moderna or anybody else too, but it wouldn't be quite as stark because, I mean, geez, Tesla. It's like the poster child for that question.
Yeah, yeah, it's these two sides, and it's like what?
Mhm.
I don't know. Yeah, you don't know whether to make heads or tails of it.
And 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 supporting the guy who said he wants to end electric vehicles. Come on, dude. I mean, maybe he's backing him very, very cynically because he thinks if I've got his back, he won't defang Tesla. Maybe. He might just be doing it for business reasons too. He's not stupid. I don't know. Complicated. And on some level unknowable, which great.
So I think we'll let Paul ask his question really quickly, and then after that we'll do a quick wind down. I've got a few other very awesome events to plug, but this is a awesome conversation so far, and I am enjoying it so much. So feel free to fire away, Paul.
I know it's 6 o'clock and you've got to wrap up, Matt. I'm wondering, Garvin, if you could stay longer so Matt could wrap up the meeting and we could keep talking.
I am supposed to be meeting some folks at 6:30, so not much longer, but maybe a couple of minutes. Also, I'd be happy to volunteer to have a follow-up meeting if you'd like to have a much longer discussion, but I do have to go pretty soon.
All right. Well, on that note, really quickly then, just while everybody else is here, I wanted to just kind of plug a couple of cool other webinars and events that we've got coming up between our organization and 350 Chicago. I will drop the meeting notes one more time in the chat just for everybody's ease of knowing what I'm talking about. But if you scroll down to the bottom of that page, you will see that next Wednesday we are having a webinar with Tanya Das, formerly in Biden's cabinet, but currently working for the Bipartisan Policy Center on bipartisan climate policy. So expect to hear a great conversation about what the inner workings of that look like, new perspectives on climate policy, and that'll be from 6 to 7 p.m. next Wednesday. All right, sorry, not next Wednesday, this upcoming Wednesday, the 24th. And then finally, we have the Power of Regen Ag to help address the climate crisis. That is a webinar hosted by 350 Chicago that we are co-hosting with them. That is going to be on Tuesday, July 23rd from 5 to 6 p.m. Mountain Standard Time. And there's a registration link in the notes doc there for any and everyone that is interested. And yeah, with that, feel free to stick around for a few more minutes if you'd like to. And if not, I hope you have a great weekend and thank you all for being here. I'll plan on uploading this to the defunding climate disaster portion of our website and adding the slide deck once I get those from Garvin. I would say a realistic timetable on that would be probably Monday evening. So just so everybody knows. But yeah, with that, I will pass it back to Paul for his question.
Yeah,
Great.
I'll probably shoot
Thank
you
you,
next
Matt.
Monday morning if that's okay, Matt.
That is A-okay with me. Thanks.
Cool.
Yeah. Garvin, you touched on this a little bit with GM. I'm thinking of Mitsubishi right now. I own a Mitsubishi heat pump, which is a great product. It's doing really well for me.
Cool.
But I haven't studied the company, but I assume they still make internal combustion engines for cars and motorcycles, airplanes, and whatever.
Yeah.
But that's the way of the world, is that these big companies are going to start dabbling, and hopefully they continue to do more and more. How are you looking at that? How are you considering that?
So yeah, well, that's a good question, and you're right. Big companies, a lot of them are just big conglomerates, and they've got lots of tentacles. Some of which may be sustainable, and others of which really are not. Mitsubishi falls into that category. They make a ton of ICEs and diesels and all kinds of destructive things, and their heat pump business does not offset that, in my opinion. Partial offset, but that's not good enough. All this incrementalism and partialism is keeping us in the climate crisis, is the truth. And so I'm not really down with owning those shares. However, when I think about a big conglomerate like that, or GE, for example, they've got this big wind turbine business, right? Cool. They're also the world's biggest manufacturer of gas turbines for gas peaker plants and such. Not cool. They've got a whole website dedicated to this being the century of gas. Like, they're huge boosters of LNG and I call it geological gas because it's not natural. It's poison. And so when I think about a company like GE or Mitsubishi, I declined to own the shares outright because they are not overall. It's sort of the opposite of the conclusion I come to with Tesla. If I look at the aggregate, if I dispassionately as I can, as objectively as I can, look at the aggregate impact of the business activities of a given firm, and I can't judge that overall their actions are going to result in a regenerative economy, I can't put it in my fund. Okay. What I can do is look at the section of their business I am interested in and look up and down their supply chains. Where are they getting their composite materials from to make their wind turbines? Who's supplying the balance of systems like their inverters and such? There are some super interesting companies that you can dig up doing that homework. So I keep these big conglomerates with relatively sizable sustainable businesses as part of their overall conglomerate on my watch list because I want to keep up with what they're doing, because I can find all kinds of beautiful gems in their partnerships and supply chain companies that I might not have identified otherwise. So it's not like following those is a waste of time, even if I decline to directly own them. And as a consumer like you, I'm more than happy to buy their more sustainable products. Like if a Mitsubishi heat pump makes sense at my house, God knows it's going to be better than a furnace in terms of the climate, then I'm down. And so that's important though, because what you said is big companies will start dabbling, and then as it becomes profitable, they'll pivot that way more and more and more. So actually, on the consumer level, it helps a lot to support that part of their business because the CFO knows where the money comes from, and then they'll start investing more where the money comes from. So that's actually key. So as a consumer, I'm more than happy to buy products I like from big conglomerates that might have really destructive parts of their business. Well, I don't care about that as a consumer, but as a stock picker, I do. And I can discuss one more, and then I got to go. But Matt, Micah, I'm serious. I'm more than happy to come back and have another chat anytime you like, and you can certainly hold me to it.
I so appreciate that, Garvin. And just while there are a few more people left in here, I know you mentioned it at the beginning and just brought it back to my forethought of my mind. And just want to say this whole thing would not have been possible if Micah didn't make this connection. So really appreciate Micah reaching out to you and this whole thing, happening because it's been awesome so far. So if anyone has one more question, feel free to go at it. But thanks.
Yeah, thanks, Micah. We're all super fans. If we had more warriors like you, we would have fixed this a long time ago.
So real. And am I seeing that? Are those plus signs just to Micah there, Ron, or do you have a question as well?
Yes, I just agree with Garvin about Micah being an awesome climate superhero.
100%.
Thank you, Garvin. It's really
Yeah.
informative.
Cool. Thanks, Ron. I appreciate that.
All right, then. I'll unless anyone else has another question here, I'm just gonna round it out. And super, super appreciative of you being here and spending some time with us, Garvin. And I feel like a lot of people took a lot of great points away from this. And I saw mentioned in the chat earlier, it was a brute honesty. And that, you need to hear that sometimes because it's just, show it how it is. Don't sugarcoat it. Just be honest, right? And you need to hear it. So thank you again. Really, really appreciate you tuning up, and we might take you up on coming back and having another conversation here in the future. This has been awesome.
I'd be pleased to do that.
All right, y'all. I hope y'all have a great weekend, and thanks for showing up. And this will get uploaded hopefully Monday afternoon or Monday evening. So I'll send that link out too in an email. I can send it to everybody that was here. So I'll get that out to you.
Have a great weekend, everybody.
Great.
All right. Bye,
Thank
everyone.
you.
All right. And end recording.